Hey, it's Jim, and this is level 3 of the CFA program, the topic on equity portfolio management, and the reading on passive equity investing. You might be tempted to interpret the title of this reading, especially that word passive, as being the opposite of active, which I guess it is, but I don't want you to fall into the trap of thinking that passive investing means that we don't have to do much work. Of course, active investing takes lots of research, takes lots of resources, takes lots of our time. Passive investing may not take up as much resources and time as energy, but is still super important to understand that there is still work to be done. I also don't want you to be tempted to identify passive investing and indexing as one and the same, although kind of in the industry, those two terms might be used interchangeably. Remember that indexing is just trying to replicate the performance of some type of an index. Passive investing includes indexing, but it can also include focusing on different kinds of factors. Remember, we had that beautiful conversation back in level 2 about the Fama and French model trying to identify factors like, maybe value or size or some other factor. So my point here is that this is a very straightforward reading, and the 14 questions at the end of this reading are very straightforward, but I don't want you to get soothed into thinking that these won't be difficult questions on the exam. So let's make certain as we go through these LOSs that we get all 14 of these questions right at the end of this reading, because you can handle this. I promise you, you can do this. Now, one of the things I did right before I hit the record button is I went back and I took a look at those 14 questions at the end of the reading. And boy, the Institute does a great job of identifying each of these LOSs. So these are equally important. And I imagine that on the exam, the Institute is going to just maybe randomly pick some of these. So you'll need to know how to compare and discuss and explain. And hopefully I'll point these out as we go through the slide deck. So let's do just a brief recap. Notice that first arrow point. Almost one and the same thing in the investment industry, but they're not, as I explained earlier. So what are we doing in indexing? We're trying to replicate the returns of a benchmark index, and there are a handful of indexes there at the bottom. And of course, we're not limited to these indexes. We could have, I don't know, how many out there are there? 100, 1,000 different indexes. So I'm guessing that the Institute might refer to one of these very popular and well-known indexes, but they might say something like, here's a broad equity index that has focus in large cap or small cap or something else like that. So don't be upset if you see on the exam not the Dow Jones Industrial Average. I'm guessing you know these advantages. One of the cool things about having a finance trading lab, we have access to the Morningstar software. I'm guessing many of you do as well. When I teach my undergraduate students about mutual funds, we go to the Morningstar and we pull up a mutual fund and we go through all different sorts of things. And of course, these 3 boxes at the top of this slide, they kind of pop out. Low cost, diversification. Now, I oftentimes warn my students. I say, all right, let's look at the Vanguard 500 index fund, right? So we look at this thing. That's called wide diversification. I use this term. Don't you tell any of your other professors that I said this. I use the term kind of nearly complete diversification with the S&P 500 index. It's not complete. Because it doesn't contain all of the equity securities that are out there globally. But I caution my students that some mutual funds have only 30 or 40 stocks. So you get some diversification benefits. I'm not sure if it's wide diversification or something, but clearly the advantages of indexing are diversification. And then there's the tax efficiency as well. Now, passive investing, this would include indexing because you invest in the index and then that's a passive strategy. But it also includes, well, let's go ahead and read that diamond point down there. Boy, investable strategy, it's rules-based, it's transparent, but it's not based on doing some extra research, like the active researchers do, some extra research to try to identify under or overvalued securities. All we're doing is saying something like, hey, here's a bunch of stuff out there, these equity securities, and we want to pick, I don't know, half of them or something like that. So rules-based. Now, this is what I was saying earlier, like with the Eugene Fama and Ken French model that we started back in level 2. Look at those bold points down there. We can invest in various market segments, unlike that in indexing. So we can find factors, we can find segments, we can find industries, we can find almost anything that we want out there. And that's still considered to be passive investing. So choosing a benchmark, what do we need to do? Rules-based. And this pretty much is outlined by how do we establish the initial strategic allocation, and then what happens inside of that allocation? How do we rebalance those weights? Because those stocks some will increase in value, some will decrease in value, and then we need to worry about what happens when those stocks increase or decrease in value by so much that they are then removed from the index. So we need to have some rules there. Has to be transparent, of course. We need transparency. We hear that word all the time. The rules must be disclosed to the public, representative of the intended strategy. That makes perfect sense. And then investable. You don't need me to tell you anything about that. All right, how about extra considerations in choosing a benchmark? So desired market exposure or the risk factor exposure. So think about going back to Eugene Fama and the efficient markets hypothesis, and then William Sharpe and even Harry Markowitz. So what did we decide? We decided that stock returns are a function of two basic factors, economic factors and firm-specific factors. We learned that, decades ago. So these are two considerations here. So look on the left-hand side, desired market exposure, right? Look, developed, emerging, and frontier markets. Broad market exposure versus some kind of a focus. So, what we're saying here, that we want this market exposure because we want to be exposed to the entire market or nearly the entire market because, well, this is what I've said to you guys many times. I did in level 1, I did in level 2. Look, when you invest in a well-diversified portfolio, here's the economy. You're just betting that the economy expands. And if you're indexing or are you passively managing a portfolio that as the economy expands, then your portfolio is going to expand as well. So desired market exposure. Now, on the other hand, we can go down to the micro level. Now, in the Eugene Fama and William Sharpe and Harry Markowitz conversation, that micro level was the individual firm. But now we're saying individual factors. So market cap could be a size factor. Style could be a value factor. Momentum, liquidity, volatility, and quality. So instead of focusing on individual companies, we're focusing on risk factor exposures. All right, how do we construct an index? Well, it can be exhaustive. We can select every component of a universe. Think the difference between population and sample back in our quantitative methods conversation. So it could be the U.S. total market index, which would of course include every share of stocks that's traded on any U.S. stock exchange. That would be exhaustive. But it could be selective, specific characteristics. We could say, you know what, we want the 500 or the 490 or the 864 largest companies or the 212 smallest companies. Or we want to find the middle and we want to take 37 above and 42 below. And so we want to be selective based on specific characteristics. I mean, the most obvious notion, of course, is size. Now, here's a hint about an examination question. Look at the bottom right gray box. Benchmarks constructed this way have a higher turnover. So this is clearly a potential exam question to compare exhaustive and selective. All right, how do we weight our index or our benchmark or our passive portfolio? Well, the most popular method is just to take the stock price of the company, multiply by the number of outstanding shares. That's going to give us some kind of a total market capitalization, and then, total capitalization for that individual stock or factor, and then divide that by total market capitalization. You guys know that. This can be thought of as a liquidity weighted index. So here's one of those definitional terms that might show up on the exam. Read our boldness there: higher liquidity and greater capacity to handle those investor flows. So that must mean that those large cap stocks are more heavily weighted. That makes perfect sense. But then you can go to this concept of a free floating weighting, which excludes shares that are not closely held and not available to the public investors. So here you have to use some of the artistry associated with being a good financial analyst. How do you define closely held? Price-weighted index. We know the Dow Jones Industrial Average is a price-weighted index because we can read the Wall Street Journal every day and it'll provide us with the divisor. So the weight of each stock, so we stock price per share divided by the sum of all of the other stock prices. What this means is that those higher price stocks are more heavily weighted in the index. Over here, let me go back one more. Over here, the largest stocks in terms of market cap are the most influential. Here, the highest price stock. When they might be the same ones, but they might not be. So look at the bottom diamond point. The price-weighted indexes are impacted by things like stock splits, stock dividends, mergers and acquisitions, divestitures, all those things that we talked about in level 2 under that general heading of corporate finance. That's why the Dow Jones divisor in the denominator has to be adjusted regularly to reflect that impact. How about equal weighting? This is pretty much what my students come up with when I tell them, hey, let's go ahead and pick 10 stocks. And they say, okay, Jim, should we just invest 10% in each of those stocks? And I say something like, I'll scratch my head and I'll go like this. And I'll say, maybe you want to do that, an equal weighting, but why don't we do something else? But there are advantages to equal weighting. So reduces concentration risk. We'll talk about that in just a little bit. And then it reduces changes in those sector exposures. But there are problems with equal weighting because those smaller firms then tend to play a larger role. So there's probably more volatility. There's probably more balancing. There might be some liquidity issues and some other issues. What does that say at the bottom right? Limited investment capacity. Now, what we can also do, and I think this is really cool, is this concept of fundamental weighting. Notice that the reading and the slide gives you some fundamental characteristics: sales and income and dividends. And you could have any kind of a fundamental factor in here. Of course, those of you who've been paying attention to me since level 1 will know that I would pick, my personal view would be to throw operating cash flows in there, or maybe even free cash flows, which is probably going to give a better sense of that second arrow point: exploit potential inefficiencies in market pricing. What do we know? We know income, net income. We know that can be at least massaged, if not manipulated. Sales, those probably include things like accounts receivable. And, if we're a company like Procter & Gamble, we probably get people to pay us. But if we're a company like Jim's Concrete Company, then we don't really know who's going to pay and when are they going to pay. So what are some common features there? Low cost, rules-based, transparent, and investable. Now, do you remember, and you should remember this, not just from what I've taught you in level 1 and level 2 and what this institute and the program has taught you, but just by reading the Wall Street Journal. I mean, it's not every day, but clearly every week or two or three, there's some mention of a merger. And the Justice Department says something like, well, you know what? We're not quite sure we approve of this merger, because if these two companies merge, then they're going to have a high enough concentration where maybe they won't become a monopoly, but maybe it'll be a monopolistic competition, or maybe there will be some monopolistic profits in there, and consumers will suffer. Well, this is just the HHI index applied to the managing passive portfolios. So there's a good old formula down there. Notice that the LOS doesn't ask us to compute the HHI. It just asks us to discuss some considerations. But I would know that HHI formula. It's just the sum of the weights squared. You got to square them. And we have an example here in just a second. And then the second part is probably the most likely question there, the effective number of stocks. A couple of points about all this. This index can range from 1 over n to 1. If it is 1 over n, then the portfolio is equally weighted. If it equals 1, then that's just one security. So look at that fourth embedded bullet point there. That's probably a good discuss consideration. So concentration risk increases as HHI increases. So let me just give you a quick silly example. Suppose I come up with Jim's index, and it's 10 stocks, and I invest 10 cents in the first 9 stocks. So I have 90 cents invested in the first 9 stocks. And then I invest $1 million in the 10th stock. All right, so what do we say? What's the concentration risk there? The performance of this passively managed equity portfolio is going to depend on that one stock, right? Even though I could say legitimately, hey, I have a 10 stock portfolio, and I could even report correlation coefficients. I could say, well, wait a minute, the correlation between 1 and 8 is a minus 0.2. The correlation between 2 and 6 is a 0.00, et cetera, et cetera. But do you care about all that stuff? No, because there's super high concentration risk. So let's take a look at a quick example. Here we have 70 stocks, and here are the weights of the 6 largest stocks. So if you do the math really, really quickly, what does that add up to? That adds up to about 50%, right? And so look at the bottom sentence. The other 64 stocks have weights totaling 50.6. The sum of the squared weights of those 64 stocks is 0.02182. So let's go ahead and here, let me go back here. Let's go ahead and calculate the HHI, even though the LOS doesn't ask us to, and then the effective number of stocks, even though the LOS doesn't ask us to. But I think that's an important point to know. All right, so what are we going to do? You just sum those in the middle column. There you get 100%. That should make perfect sense. So let's go ahead and sum all those weights. So the sum of the squared weights of the stocks is 0.6. Take the reciprocal of that. That's the important thing. So I'm guessing, if I were making this question up on the exam based on the LOS, I'd probably give you a table like this. I think it's reasonable, and then just make you sum those, or I could just give you that 63,524, and then the question is, what is the effective number of stocks? And this is one of the 14 questions that show up at the end of this reading. So there was approximately 16. So what does this tell us? Well, even though in my silly example, I had 10 stocks, but we effectively had 1, well, here in this case, we have 17 stocks, but they perform as if it's just 16. So you get the sense of how to interpret this HHI, which was crafted for the merger and acquisition market, but it clearly has applications here. So I'm going to go ahead and repeat myself. This was a question at the end of the reading, and so I would know this for the exam. What are we doing with rebalancing? This is just a periodic weighting because prices go up and prices go down. Reconstitution is saying something like, oh, that price went way up, so it doesn't belong in our index anymore. That price went way down, so it doesn't belong in our index anymore. So adding and deleting. One of my favorite statistics is this Wilshire 5000 index. You may have heard me say this at some point before. At one point, I think it was back in the 1990s. I should know that as a good finance professor. There were maybe 5,800 stocks in that index, and I think today I think the last I have seen it's under 4,000. So reconstitution in the Wilshire 5000, that's a pretty big deal. But read that last embedded arrow point. Indexes that are infrequently reconstituted, have low turnover. Yeah, this is an interesting concept here about what do we do with migration. If we have a mid-cap index and we have a mid-cap stock that increases in value, how do we migrate it from the mid-cap index to the large-cap index? Well, buffering, what we do is we just determine threshold levels. It's a slow and gradual process so that if the price rises and keeps rising and keep rising, sooner or later it's going to end up being deleted from the mid cap and then fully included in the large cap. But we can also packet, this concept of packeting into parts. And what we'll do is work through an example here. So we have our reconstitution date. So the market cap increases. So what happens? It then qualifies to be a large cap, to be a member of that large cap portfolio. But what we're going to do is we're going to just take a portion of those holdings and move it to large cap, and then keep the remainder in the mid cap. And under that next reconstitution date, if the prices continue to rise, then we just throw everything in the large cap and it is removed. So packeting, it's removed gradually. All right, look over on that right red box. Example of Fama and French. So I've mentioned these two dudes at least twice during this particular recording, and I mention them pretty regularly. So that's a multi-factor model, which means that stock returns are driven by multiple risk factors. I mean, you could come up with any risk factors that you like, but of course, value and momentum and liquidity, those seem to be, kind of common factors that drive stock returns. Remember now, in 1964, William Sharpe, among others, showed us this capital asset pricing model, which is a single factor model, which tells us that the returns on any individual stock are a function of what goes on in the market portfolio. And so this is what I was saying earlier, that if the economy expands, then the market portfolio will increase in value, and then your individual stock or individual portfolio will react based on the value of its measure of systematic risk, which of course is beta. And so I always tell students this. I say, look, if the market goes up by 10% and you have a portfolio that has a beta of 2, well, then you can reasonably expect it to increase by 20%. Now, that's not, of course, the capital asset pricing model, because you have to figure out and include a measure of the risk-free rate of interest. So depending on whether the risk-free rate of interest is 0 or 5 or 10, whatever it is, that'll cause some subtle changes in what was my final answer, 20%. So, maybe it'll be a little bit less than that. But the important point here is that single factor versus multi-factor models, make sure you know the difference between the two. But I'm guessing you remember that from previous lectures. So here's what I said earlier: size of the firm, there's value or growth down at the bottom left. Operating profitability, I'm way more in favor. Now, that's just my own personal opinion. I'm way more in favor of throwing operating cash flows in that numerator down there. But the Institute has operating income, and so that's perfectly fine. And then we get that market risk premium from the capital asset pricing model. So it might be helpful to think of that blue box as William Sharpe, and that's the first factor. And then we add some factors, size, value, things like that. Now, passive factor investing involves overweighting and underweighting certain risk factors. So remember what I said to you in the introduction. I said, let's not be tempted that we're going to just do a little bit of work now and then go watch the Super Bowl and not worry about anything. No, we're going to do a little bit of work now and then we're going to do a little bit more work later and then we're going to keep working, right? We're going to work really hard for our clients because after all, they're compensating us for crafting their policy statements, and we need to provide them as good stewards of their capital. All right, so equity risk factors, we know this. Growth, we know these are high price earnings, high price to book, above average net income growth. So there's growth, there's value, which is kind of just the opposite. Low PE and low PB ratios. Size, we know about size, we know about dividend yields, we know about momentum, we know about quality. I want to caution you here. Remember all the way back in level 1, we had a reading on measuring the quality of the financial statements. And that was a little bit from an accounting standpoint, but it was also a standpoint from the work that we do as good financial analysts. So look at the wording here. We have consistent earnings and dividend growth. What I'm going to add to that, all right, then high cash flow to earnings. Oh my gosh, don't you love that as that third or second bullet point? I'm going to go ahead and throw the word sustainable in there because I think this is a legitimate question for the CFA Institute in the question stem to say something like, hey, here's a company, Jim's Concrete Company. It is the dominant firm in the industry. It is the brand name. That was my point here. So if you have a brand name product line, you're probably going to have consistent earnings and dividend growth, high cash flows, and you'll probably have low debt to equity ratios, mostly because these branded product lines are characteristic of mature firms. All right, so keep that in mind as you sift through the question stem under quality. And then, of course, volatility. We talked many times about the Black-Scholes-Merton option pricing model and standard deviations and all different sorts of volatility. And so we'll talk about that here in just a few seconds. So risk-oriented strategies focus on volatility risk. This is what we did in Harry Markowitz. Harry Markowitz gave us this model where we found the portfolio that had the lowest possible standard deviation for each given level of risk, subject to certain constraints. And when I teach my students how to do this in Excel, we only have 2 constraints. The first constraint is that the weights must sum to 1. The second constraint is, well, let's just go ahead and pick a return. And then we do this multiple times. But those subject to constraints there in the bottom left box, they could be, kind of almost anything that you get out of your client that is client specific. Now, it's difficult to put this in an optimization framework, but from previous readings that the Institute is very interested in the ESG possibilities. And so that might be a constraint in that bottom left-hand corner, but I'll just leave it at that. It might be. It won't be a math question, but it might be some kind of a do you agree or disagree with it. All right, return-oriented strategies, yield, quantity, and momentum, and then diversification-based strategies. So minimize the concentration. That's what we did just earlier with that HHI. Yeah, we can have pooled investments. You guys know about these ETFs and open-ended mutual funds. And what did I say earlier? I think in my introduction, I said something like, oh, we can just do this and forget about how we can use derivatives. So, man, let's go ahead and talk about this. In fact, I would love to keep you for 30 or 40 extra minutes, but I won't do that here in derivative-based portfolios. So remember, we've got this passive investing, and we're going to have some stocks that increase in value, some that decrease in value, and those, they might be pockets that have derivatives written on them. I mean, clearly we can use a call option on an individual stock. We can use a call option, and I'll go ahead and say put option, and we can write or buy these kinds of options. And what we can do is we can modify the portfolio beta back to its target beta with those derivatives. In fact, we can even replicate or mimic the performance of any kind of a portfolio with almost any kind of a beta. So let's go ahead at those three block points there on the left-hand side. What can we do with options and futures contracts and swaps? We can change the portfolio beta, we can change the weights, and we can adjust the foreign exchange risk. Remember that whole reading we had on hedging returns and unhedged returns? The simplest way to handle this is with a forward contract. The simplest and the cheapest way is just to use a forward contract. So remember those three uses of derivatives that can change and help us be better passive managers. In fact, let me go ahead and say this. You could do this. Boy, don't ever tell the Institute I said this, and don't tell your finance professors I said this. You could theoretically put together a passive portfolio, and then every Friday you could look at the performance and you could say, all right, I need an option here and a futures contract here and a swap contract here to get me back to where I was or where I want to go. And then you could wait a week and you could unwind those positions and you could do all this. I mean, derivatives and their applications are so amazing. But I'm not quite sure that's what the Institute wants you to do with this LOS. Just remember that derivatives can be used for almost anything, but you need to identify the risk, quantify the risk, and manage the risk. Remember, during the financial crisis of 2008, lots of people did all but three of those strategies. All right, low cost, easy to implement, leverage, trade in liquid markets. We want that. And we love all those advantages there. And you could put another one down there that says, Jim loves these. That's another advantage. Disadvantages, well, when you're in the derivatives market, you need to worry about what goes on in the derivatives market, right? It's not the spot market like the floor of the New York Stock Exchange. They have rules over here in the derivatives market. So we need to worry about things like margins. We need to worry about basis. We need to worry about counterparty risk. We need to worry about rolling over futures contracts. We need to worry about the lack of convergence, cross-hedging, all those kinds of things. So this is what I've told you guys before, and I tell my students, I tell my children this all the time. I go like this, and my children, they just shake their head when I do this because they know I mean. Look, marginal costs versus marginal benefits. Decide, is it worth it? I mean, there are a lot of great things that go on over in the derivative market, but is it worth it? Is it worth it for the extra stress? And that's pretty much the question. All right, how about these separately managed equity index-based portfolios? Holding all the components of component stocks in an index, or at least a representative sample. Now, this is really hard to do because up-to-date data on the index at any given point in time. I mean, we know what those 500 stocks are in the S&P 500 index. But as you read the Wall Street Journal, on a weekly or clearly a monthly basis, you'll see an article that says, oh, by the way, these two firms are in, these three firms are out. And so, boy, on any given day, there might not be exactly 500 in the index, although I think most days that there are. Go down to the green box, complex trading and accounting systems. This is a really cool thing because the Institute is trying to build up our knowledge of these trading and accounting systems so that we can at least understand them. I mean, we don't have to be experts in this complexification, but we need to know them, just like we don't need to be lawyers, but we need to understand these compliance systems. And then, of course, a good relationship with everybody in the industry, but especially with the brokers. Full replication, boy, what are we going to do? We're going to go out and we're going to just go out and buy all of the securities in an index. So if this is the Wilshire 5000, what did I say earlier? You show up and you think, okay, I need to buy these 5,000 stocks, and you find out there's only 3,742 of them. Or what did I say? 3 decades ago, there was 5,846 of them. I made those two numbers up, by the way, but they're probably relatively close. Suitable for indexes with small numbers of similar liquid stocks. That is a super sentence to remember for an exam question. So my Wilshire 5000 example, that was silly, and we knew it was silly. Closely replicates the index, so of course that's the advantage. But what's the disadvantage? It's costly, and there's that regularly reconstitution and rebalancing. Now this takes us back to all the conversations we had in quantitative methods, stratified sampling. This is really a cool thing. So we have this big old population, and we're gonna figure out some subsets. I mean, essentially all we're gonna do is try to chop it into different sets. And maybe it's based on size, maybe it's based on something else. And if we have 100 stocks, we could stratify them into 10 different subgroups. And no stock is in any of the other ones. It's just in one of these things. And so what we can do is we can say something like, okay, instead of 10, what did I say? 100 stocks with 10 in each exhaustive subgroup. Well, let's just take 2 here and 3 here and 4 here and 2 here and 1 here. Lower cost, that makes perfect sense. Suitable in cases of relatively low level of assets under management. There's no sense in spending all that money for full replication. Straightforward. Now, the problem then is that when you pick 2 out of these 10 and 4 out of these 10 and 3 out of these 10 is that you're probably going to have some kind of an error out there. We call that tracking error, and I'll show you that equation here in just a second. The size of the sample to use is super critical. Go back to my Wilshire 5000. You're going to have a super high tracking error. Are you going to go ahead and chop those 5,000 into however many exhaustive subgroups that you want to, and you're going to pick some out of those? That's a tough one. Lots of costs. Once again, marginal cost versus marginal benefits. Optimization. This is the Harry Markowitz, but this is an extension of Harry Markowitz. Maximizing a desirable characteristic, or minimize a undesirable characteristic, subject to all sorts of constraints. So we might want to minimize rebalancing costs. We might want to maximize return. We might want to maximize a premium over the risk-free rate of interest. I mean, in Excel, you can set almost any constraint that you want to. Of course, it has to be reasonable. So advantages here is if you do this minimization or maximization, you're probably going to get a low tracking error, but it's costly. And the question then becomes, what kind of data are you using? If you're using historical data, which is what my students and I do in class, we just go to Yahoo Finance and download, 3 years worth of monthly prices right into an Excel spreadsheet. I mean, we do it so quickly. But the question then becomes, are those 3 years of monthly prices, are they relevant to the next month or the next 3 months or the next 3 years? Sooner or later, you have to ask yourself the question, all right, I'm going to go with history and I'm just going to hope for the best, or history is the best predictor of the future. Oh my gosh, didn't we talk about all that back in quantitative methods? Now look at that bottom, may generate mean variance, inefficient portfolio. So what did I say at the beginning of this? I said, hey, this is the Harry Markowitz stuff, but we're adjusting it and we're substituting objective functions, whether we're minimizing or maximizing, and then we're throwing a bunch of extra constraints in there. And so when you do this optimization, you can draw a frontier. And what the Institute is saying is that it might not be the efficient frontier from our Harry Markowitz days. It might be, but it might not be. The certain statement that I can make is that this frontier might lie below the Harry Markowitz efficient frontier, but it's not going to lie above and to the left in that unattainable region. All right, here we go. Let's start our conversation on tracking error. I learned this in my early days in my PhD program, this concept of an excess return. And you can define excess return in almost any different kind of a way, but the Institute does it here in this reading by taking the return on this passive portfolio and subtracting out some benchmark return. So there's a good equation. And this is a simple equation. You learned that in kindergarten, right? You learned to add and subtract in kindergarten. Now, what we want to do is we want to take the standard deviation of those excess returns, and that's called the tracking error. And so there we go. We've got the square root of the variance in there. Look at the bottom arrow point. Low tracking error is good. What that means is that a low tracking error tells us that the manager who has done some of these things, let me just go back here, optimization, some kind of sampling, full replication, all this kind of stuff that we went through over those last 12 slides or so, a low tracking error is telling us that wealth manager did all sorts of really, really good things to generate a low tracking error. All right, what are some other causes of a tracking error? Fees charged, number of securities in the portfolio, intraday trading, cash holdings. Let me go back here real quickly. This was a question at the end of the reading. I forget exactly what it said, but there was a question on tracking error and the source of tracking error. And one of the answers was like stratified versus full replication. And one had something about cash drag in there. So remember these four as causes of tracking error. That makes sense. How do we control it? Minimize trading costs, netting cash flows. Oh my gosh, look at the bottom left. Oh my, can we use derivatives in any case, in any possibility? Of course we can. If we have $100,000 in cash laying around and we know we're not going to invest it for another week or two, well, let's go invest it in an equity futures contract so that we can at least get close to whatever happens in the equity markets over the next week or month or whatever it is. Now, this is one of my favorite topics, this attribution analysis. And so I'm going to give you just a quick example. Let's suppose that I'm your financial advisor and you throw a bunch of money at me and I generate a 10% return during the course of this year. And you want to know what the benchmark was. So, suppose the benchmark return was 8%. So I had 10 and the benchmark was 8. So we're happy, right? I outperformed the benchmark. But then what we can do is we can attribute that outperformance, that excess performance to things like, well, there we go, on the right-hand side, company-specific returns, sector returns, country returns, or currency returns. What we can do is we can say something like, and this is the very first attribution analysis that was done years and years ago. These researchers said, did we outperform because of asset allocation or did we outperform because of security selection? These are two different kinds of decisions that go into portfolio construction. And attribution analysis helps us identify whether or not we were just lucky or whether we were good in a certain area or bad in a certain area. Now, we can also add securities lending to a passively managed portfolio. We can short sell, and we can do a number of other things. This will probably result in lower fees. This will probably reduce tracking error, but there might be some market risk. There might be some credit risk. And then notice down at the bottom, investor activism and engagement. This is just a small part of the reading, but this is what I was saying earlier about the Institute being highly interested in ESG issues. So what are governance issues? Well, there's the board of directors and there's executive compensation and there's that operational risk, which I always have to remind my students, operational risk includes lots and lots of things, but it also includes human error. Haven't we had this happen on the floor of the New York Stock Exchange where someone hits that button when they should have hit that button and then there's mayhem all over the exchange. And after 20 minutes of panic, somebody comes in and says, it's okay, let's go back to watching the Super Bowl. All right, how can we increase returns to index stocks? Better manage risk. So this is exactly what I was saying earlier. Identify risk, quantify risks, and then manage the risk. Improve better operations, provide better board oversight. All right, so that takes us through these learning outcome statements. I think I pointed out a handful of questions at the end of this reading. So this is what I want you to do. I want you to do it right now. I think you're fully prepared to answer these 14 questions. So I want you to hit the stop button, get out the reading, and go to those 14 questions. And I'm guessing that you can make it through those 14 questions in, well, I want to say 14 minutes, but that might be too ambitious. Anyway, I had fun during this relatively short video. Thank you for watching, and good luck studying.